Tax implications, my question is, are there any? And I got made fun of this one time because I don't know who Will Rogers is. I guess he's like an actor or something. Hey, I'm younger than Kyle. So, but he said this: the difference between death and taxes is death doesn't get worse every time Congress meets. And I did check this with the CPA, so this is confirmed, but there's only 2 tax considerations when you're talking about paying off debt. The first one is when you pay off debt, the biggest consideration is that you're no longer going to have those interest payments to write off, okay? Yeah, you're going to increase your cash flow because all of a sudden you don't have those mortgage payments, but you're not going to be able to write off that interest. Everybody knows that when you make a payment, a portion of it is principal. That's considered income. Now, that's not income you can eat, but that's like a little savings account over here that you can use later. But that is considered income on your tax return. The interest portion is the expense side. If you pay off debt, you no longer have that expense to write off, and you'll have an increased income. But the good thing about real estate is there's a thing called effective tax rate, and I'm going to read to you what that is. It's a measure of the actual tax burden faced by an individual or entity as opposed to the statutory tax rate, which is the rate set by law. So basically what that means is, you know, the United States has like a tiered system. We all fall in tax bracket. So we all pay a certain percentage of tax on our income. With real estate, you get to depreciate a lot of that, and you get to write off a lot of your income. So my effective tax rate is actually less than 5%. So even though if you pay off debt, you have an increase in cash flow, an increase in income, a lot of that depreciation will still cover you and tax shelter your income, okay? So you might want to look up effective tax rate. The second big one is there's no extra capital gains. I think a lot of people get confused. They think that capital gains is paid on the sales price versus what they owe on the property. And that's not what's true for capital gains. Capital gains is your cost basis. Capital gains is what you bought it for, plus your depreciation recapture. And the difference between that and what you sell it for. So your capital gains does not go up or down, whether you have debt on it or not. So those are the 2 big tax considerations when you're talking about if I'm going to pay off debt or not.